Are you ready for $10 a barrel? That is the contrarian call our guest host Gary Shilling made just a month ago. Since then, though, crude has been hovering around $50 a barrel and has dropped below that mark this morning. Gary, has your reading of the market changed at all in the past few weeks?
Well, I think that we're beginning to see the next leg down in oil. And, you know, the reality is that cartels exist to keep prices above equilibrium, and that encourages cheating. So the leader of the cartel has to accommodate the cheaters, and that's the Saudis, and they said, hey, we're tired of that. So they're playing a game of chicken. They're saying we can take lower prices longer than the cheaters.
Okay, but everybody's over on the supply side, and I'm going to bet the bank that Gary Shilling's looking at demand destruction. Is part of your call to go below Jeff Curry at Goldman Sachs, to go below Ed Morse at Citigroup, for you to make headlines is not just about supply dynamics, it's about demand.
Hey, we wrote this in our monthly newsletter 3 months ago, Tom, right after the Saudis pulled the plug when we were all enjoying our Thanksgiving turkeys. But it's both supply and demand. It's weakness in demand, and supply is increasing.
I think this is a huge distinction, Olivia, between what Shilling's saying and the others.
9.3 million barrels a day in this country, production, and it's increasing. And other places are increasing, too. And you look at Russia. They've got to produce and export.
But I want to pin you down on this. You're calling for outright demand destruction.
No, I'm calling for increased supply and very weak demand.
Okay.
It's a combination of the two.
Gary, one thing that struck me from your note is this survey you pulled from Boone Pickens showing that of 2,222 oil fields globally, that at $40 a barrel, only 1.6% had negative cash flow.
Yeah, that's this whole idea of marginal cost, and that's what it takes to back out some producers.
So that means the chicken out price.
Yeah, that's the chicken out price.
Way
when the hole's in the ground, the oil is flowing, the pipelines are laid. It isn't the cost. It isn't the full cycle cost of new production. It isn't what it takes to meet budgets. It's the marginal cost. That's what price wars are all about.
Yeah, but as the market could clear, Ed Morse says we're going to 20, but we will clear there and rapidly move higher. Are you looking for persistently low oil prices?
I'm not that smart, Tom. I'm just saying I think you get to that point, then somebody chickens out, then you probably do get price stability. But I'm more concerned about getting there and the financial fallout of that, which I think is important, because that's what really could have further ramifications.
Let me challenge you a little bit on demand destruction. We had Tobias Levkovich on earlier this morning of Citigroup. He was saying that we are actually seeing pickups in CapEx, pickups in investment spending. I've also seen some very convincing numbers about truck spending, heavy truck spending, back up to where it was in 2007.
Yeah,
a lot of people think that's
I'm not big on the demand destruction side. I think it's more the supply. Look at Russia. Russia depends on oil to meet their budgets, to finance their imports, and as the price goes down, their incentive, their pressure is to produce even more oil and export more, because they have to do more to get the same dollars of foreign exchange.
Let's split the difference between Ed Morse and Gary Shilling. What does that do to U.S. dollar if oil's dollar-based and we go to $15 a barrel?
Well, if anything, it strengthens the dollar because the business is done in dollars, and of course what it does is it forces anybody else who isn't in dollars, it makes it more expensive. In other words, it's downward pressure, because as the dollar strengthens, which it is, it puts downward pressure on the oil price because they can't afford it otherwise.
And then Nigeria, Venezuela, and the rest of them are flat on their back.
That's right. Look at the bolivar now. In Venezuela, the official rate is 6.29 bolivars for dollars. The black market rate is over 200.
Yeah.
I mean, that economy is about to collapse. Now, that could make a difference. If you knock Venezuela out of production, that could make a difference.
What's your GDP on the U.S.? Is it morning in America?
It's GDP. It's about 2% growth.
2.0? Come on. I'm gonna
give or take. Look at the average since this recovery started at the middle of 2009 is 2.3% compound annual rate.
Yeah.
And that's what my 2010 book, that's what I forecast. I think you get that until the age of deleveraging is over, and it isn't over.